Of day 3 of, oh, go ahead. Good afternoon of day 3 of Tokenize This. Hopefully everyone enjoyed lunch. We are back to the show here. We've covered a lot over the last 2.5 days at this point, right? We started with stablecoins, payments, and on-chain settlement. We've talked about on-chain asset management and banking infrastructure. Today's theme is RWA tokenization, DeFi for institutions and the sort, and what better way to start off the afternoon than talking about the difference between tokenized RWAs and then the governance and utility tokens around them, and so forth. So before we kick off this panel, we do have a report that we made at Redstone around tokenization standards. You might see it on your on the tables. We have some flyers up front with some key takeaways, really breaking down approaches to tokenization that we've seen over the years and structures. So kind of relevant for this panel and also for your own enjoyment and reading after the fact. But without further ado, please welcome today's panel to kick off the afternoon, differentiating between tokenization and RWA tokens.
Thank you so much. How's it going, everybody? My name is DeFi Dave. I am the head of growth of CAP, and I will be moderating this panel about tokenization and RWAs. And before I get to the questions, I would like to have all the panelists to introduce themselves and what they're working on.
Hey folks, Anthony here. A Centrifuge, tokenization platform for issuing funds, assets on-chain, and helping them be productive in DeFi and being composable. I'm the solutions lead, solutions architect for both our white label product and then assisting other parts of our ecosystem. We have a ton of indices that we work with and more to come.
Igor Khmel, CEO and founder of SQFT. This is the commodity index layer for tokenization of single-family homes. I'm a serial entrepreneur, so I built in 2017 a protocol called BankX. It was top 20 ICO. And one of the first real-world assets protocols in the world.
Thank you. Thank you for having us. I wish I had a cool name like DeFi Dave. I don't. I'm Alan Konevsky. I'm the CEO at tZERO. tZERO is one of the leading regulated infrastructure providers for tokenized assets in the United States.
All right. And now for the first question. Tokenization and RWA exposure exists on a spectrum influenced by various factors, including legal rights, token holder rights, etc. For the audience, what is the proper framework to better comprehend RWAs and the rights that token holders have within it?
So when I think about the framework for thinking about tokenized assets is first thinking about like why an asset should be tokenized. First of all, like there should be a benefit that you get by tokenizing it and bringing it on chain. And then the second thing is thinking about what productivity or usefulness does it have while it's on chain, composability in DeFi and so forth. So when I think about an institution and thinking about the framework for evaluating when and why you should, ask yourself, what is the business outcome of doing this? And then think about the legal structure, because a token is merely an interface for the underlying off-chain, the fund documents, the legal structure, how to report some of the off-chain operations and back offices. But that sounds like a lot, but we're one of the platforms that help you abstract a lot of that away, so come talk to us and we will solve those needs.
I like that framing. The token is an interface for the underlying.
Yeah, look, I think you have to reverse engineer the structure from the product features that you're trying to deliver to your institutional or retail audience. That is the only thing that matters. Something that is tokenized for the sake of being tokenized is not a good product, right? It's a good talking point. You can go to conferences and other people who are tokenizing things just for the sake of tokenizing them will listen to you. But at the end of the day, users don't care. They care about what experiences this product unlocks for them as compared to the conventional alternatives. And so if you're looking at a real-world asset, let's say real estate, but that's just an example, and you're looking to fractionalize and securitize that asset, and then you're looking to tokenize it on top of that exercise. The question is, what will tokenization get that just plain vanilla securitization won't for a real-world asset? And in particular, If the answer is, well, it's interoperability with DeFi utility protocols. It's about collateral management and borrowing and lending. It's about self-custody. It's about interoperability with other tokenized assets that might sit in your self-custodied environment or elsewhere. That's really kind of the thought process for, at the end of the day, how you should be structuring it and what rights and what features you're delivering to the users. If it's chiefly about creating new distribution venues or distribution vectors, for DeFi native audiences, and that's all you care about, that's an answer, but I think you're missing 80% of what it means to be a tokenized asset if you don't think about very specific product features, and they inevitably bleed into DeFi interoperability.
Yeah, I completely agree with Alan, and would like to add, I saw the evolution of tokenization and clients and projects since like 2018. And the first was the reason why the projects go for tokenization because of the newbiness, because it's like kind of new type of asset that didn't exist before, and investors just wanted to get it. So it was like the natural way to sell something which was like the new form factor. So, but the people often forgot that there is a cost attached to that new form factor. Back like 2018-19, it was impossible to find a lawyer in New York that will serve you, and they charge you for the same thing like 3x, like to create the same SPV, but they're gonna say the word token, that will be like 60K instead of 20K. So, and it was all the time like that. So this is the cost that you're paying. It's great that right now it's become much better. So because of Clarity Act, because of these things, it's become much easier to find a lawyer. It's become possible to open bank account. We're still not there, and right now we see another logic why the people do the tokenization. And the logic became, I think one of the first one is distribution, especially overseas. So if you want to reach international investors and they want to sell, like in our case, US real estate abroad, so the token is their natural answer for that.
Alan, you talk about DeFi and composability, so I'll throw this question to you. Once a tokenized RWA becomes collateral on chain, you'll be able to access the world of DeFi, but at the same time you stack crypto risk on top of real asset risk. How should institutions approach this type of opportunity while remaining cautious about the risk?
Yeah, no, look, absolutely. I think from an institutional perspective, it's funny, you see this in the emerging public equities tokenization platforms, which is different from RWAs, but there are some really good learnings. And part of it is that institutions are still fundamentally cautious about some of the DeFi features that give meaning to tokenization. Starting with on-chain custody. There are not a lot of hedge funds out there that are parking their customer assets in MetaMask wallets. It's not happening. Whether it'll happen down the road, particularly as the market evolves, as the security picture evolves, that's a different story. But as you're thinking about institutional users for tokenized and fractionalized and securitized real-world assets, you have to think about what their needs and concerns are. And some of the things that really make it attractive from a retail perspective, DeFi interoperability, self-custody, control over my asset, are less important to institutions than security of their customer assets. And so the role of, this is not a plug for tZERO, I mean it is, but is that institutional on-chain custodians as an alternative or in addition to self-custody are important features to have in the ecosystem if you are bringing out tokenized RWAs and you want institutions to be active participants in secondary trading and potential DeFi interoperability. You have to provide a choice of custody solutions and not just self-custody. So that's important. I think as you think about what the needs of that particular segment are, because they're going to be less focused on some of the more philosophical things that appeal to retail.
Yeah, I would like to add that it's important for financial institutions is to follow through security, cyber security, obviously insurance coverages for custody and other elements. Second important element is it's a compliance. So especially if it's a compliance, either a whitelist check for qualified investors during their initial coin, like initial offering, or secondary market. This is the compliance for travel rule and anti-money laundering, especially for cross-border payments, so and cross-border investors. And there is like special category of infrastructure providers, which is like basically bring this compliance and bring those factors for institutions, so they're able to plug into traditional DeFi. So there is whitelist, there is companies like Notabene and others that is enforcing those compliance. So this is the ecosystem of the players that makes institutions comfortable and open higher credit limit to work with these plans.
You know, 100%. And I'll tell you, that's one of the pieces that often goes missing, and I think that's been a fundamental flaw with the tokenization industry, starting with some of the least liquid, most opaque asset classes, and then thinking that the technological act of tokenization is going to create liquidity, is going to create price discovery, and it doesn't. And so, if you're thinking about that, in addition to compliance, in addition to a range of custody options, you got to think about market structure. Tokenization in and of itself doesn't make anything liquid, right? And there's this fallacy there because people look at crypto and they say, well, crypto is liquid. Although if you really understand how crypto liquidity works, I'm not sure you're going to want to import a lot of it into other ecosystems, but crypto is liquid, and so therefore if I tokenize anything else, it's going to be liquid too, just by virtue of being tokenized. And that, of course, is fundamentally wrong. Without creating the right market infrastructure around supply, yes, that's what we're talking about, but also on the demand side, and not just native demand, but market makers, and what that entire ecosystem looks like.
One thing I'll add quickly before we pass it back is a lot of the points are very valid. Qualified custody, huge. We announced today with Kraken Institutional, that's one of our products. We can probably work together very shortly. What we've thought about from a platform perspective is when people want to tokenize the underlying, like the primary, we'll call it, like Janus Henderson, Apollo, when we work with S&P 500, like Dow Jones or New York Life, when we're building these funds on chain, not everybody wants to do KYB, and sometimes there's markets that want access to these tokens in DeFi that are not wanting to do compliance in a traditional way. So we have this other wrapper product, which we call our secondary, which is the DE-RWA. So if those who are not familiar right now, you can go on. Those who are not American, you can go on to certain decentralized exchanges, and they can, on Uniswap or Aerodrome, on Base, get the SPXA. So DE-SPXA is that freely tradable and liquid asset for those who want exposure to the S&P 500. And it is tracked by Janus, ourselves, and Dow Jones on-chain. And so you have access to that underlying, and you have relationships with qualified custody partners that can give you access to the primary and secondary markets. And then the third thing I'll say is about liquidity. We've solved for this too. And so Grove, we have this $1 billion instant redemption facility. So if people want access to these secondary markets, we have that available. And then we can work with other folks like Symbiotic, Multi-Liquid, and so forth, where we can, in different tranches of liquidity pools, we can give you access to other indices at the same scale for the same redemption facilities. And so we've thought about a lot of this, and I think we don't want you to think about a lot of that, so come to us and we can solve that kind of vertical of primary, secondary, distribution, liquidity. We have the answers.
So something I heard a few times in your answers are redemptions and liquidity, which are two very vital issues for this stuff to work. Everybody wants to tokenize the world, but if you really talk about this liquidity part, how can token holders protect themselves from illiquidity and redemption issues?
Yeah. Nobody wants to be bank run. People want access. People often ask themselves, or they should be asking themselves when they touch an asset, like, how do they get out of this? What is your horizon for redeeming this for actual cash? You're giving up some liquidity to hold something, a vehicle of sorts. And sometimes you want to exit that vehicle at a certain time. And when you don't, when that rug is pulled out from under you, as like a phrase we'll use in our industry, what do? And so you should be thinking about when you buy these assets, who is the issuer? Who's the platform with which they're issued on? What is the liquidity sort of setup? Is it tZERO? Is it T+3? And then what kind of, we call those failure modes. Let's say something is T+3 and you want to get out quicker. What kind of liquidity venues do they have, these credit facilities set up to help you as a qualified customer get out when you need to? And we're, again, one of those players in this space who thought about all of these scenarios for you. And so if you're both a qualified and non-qualified person who wants to either touch the DE products or the primary underlying indices, we can work with you to make sure that all your liquidity needs are met. And we do that through the life cycle of both pre-launch and then in the maintenance of the products we sell. A JRTSY, like a treasury product, JAAA, a CLO, HYB, a New York Life high bond fund that's coming out very shortly, and then some other stuff we'll talk about later.
Yeah, we're addressing the same problem. Yeah, first of all, there is a solution, traditional solution in DeFi markets called AMM, automatical market making. So, and Uniswap, Curve, like they're solving this for years, this problem. And looks like right now RWAs, they are moving to this platform, to these pools as well. And they're limited in terms of what they do. There is a squeeze risk, and but it's good like for like a small exposure. Our solution, like for real estate, what our company is doing right now is to building a standardized commodity index on top of like huge pool of many like tickers on the real estate market. So the secret sauce that it should not be yield generated. It should not promise return. And that's why it should go under CFTC, and it should go under like listed on all the exchanges. This is the only way to get all the liquidity together and to get this in one place rather than in many small pockets, and then figure out the automatical trading pools of this commodity index versus like each of these millions of those smaller tickers. So this is like this is the beauty of tokenization, that we can get access to those like instruments that is already tested in DeFi markets, and that we can right now implement to the traditional.
Yeah, look, the question is going to be what is feasible in the United States, what is feasible globally. Some of the liquidity support measures that you see in crypto markets outside of the United States will not work in the U.S. securities industry. Some will. And if you are an investor or already a token, thinking about being an investor or already a token holder, it's not really on you to to put liquidity in place. You have to make sure that the sponsor has the right plans with the right venues. In the U.S., unless it's a listed security, it has to be an ATS, with the right native demand on the platform, with the right market making, and that these market makers are appropriately incentivized, whether because there's native demand on the platform and they can manage their book that way, or whether there's compliant backstops from issuers or platforms that effectively pay the market maker for liquidity and pay the market maker to quote prices with the right spreads. It does no one any good to have a platform with no native demand and a market maker that's writing ginormous spreads that effectively mean nothing from a liquidity perspective. So unfortunately, it does mean drilling into the details of liquidity that in traditional securities, you take it for granted, right? You don't go out and diligence kind of what the liquidity picture for Apple stock is on XYZ exchange. You take it for granted because it works. And the same thing for even kind of public equities with thinner liquidity profile than a company like Apple. Now, when you get to private conventional equities, you get into the same kind of questions that you got to ask for tokenized assets as well as, and just don't get sold on labels, right? Just because XYZ exchange might be interested in ABC security doesn't mean that you're going to get any sustainable liquidity on it. Again, unless there's native demand, unless there's market making or other types of artificial liquidity support that's available, that's incentivized, that's quoting the right spreads, and that actually works. And again, if you don't have the right infrastructure as part of kind of the market, as part of the overall market infrastructure on the custody side, for example, you're not going to get institutional money necessarily because if it's an entirely DeFi-led custodial ecosystem.
But isn't that a chicken-egg problem? Like, you need to have liquidity for there to be demand, but there also needs to be demand for there to be liquidity. So, like, how do you think about that?
Well, I think that's a fundamental problem for why the industry that started with the least liquid asset classes, the least transparent asset classes, and was hoping that tokenization was going to create liquidity and was going to create price discovery and was going to create disclosure, does no such thing. That's why I think some of the momentum in the industry now around public equities that are liquid, that are disclosure rich, that are and the tokenization ecosystem that gets created around public equities, that gets created around cash products, can then loop around and then support tokenized RWAs and tokenized private securities, because these measures will already exist.
And something that is making its way through Congress right now that could actually bring a lot of demand to these tokenized assets is the Clarity Act. I say there's like a 50-50% of it passing. What would it mean for the Clarity Act to pass, and what would be the consequences if it doesn't pass? Alec, yeah.
Kind of depends, because in our industry, we have a lot of companies who've built products and they're registered in like BVI or Caymans. So there's people who are already planning. It's almost like I used to be in OTC capital markets when Brexit was happening, and so up to that, we planned for 6 months and created a whole team in Dublin just to anticipate whether or not Brexit would or wouldn't pass, and these people would or would not have jobs regardless of how it went. And in the same vein, we're creating products in and around supposed regulation in the United States. And so our current product suite, not all of it, is available in the United States. All that the Clarity Act would mean for us is that we just grow a product suite to support the United States. We'd love things to come home, we'd love things to be here, but most of our work does happen in BVI and Caymans, and a lot of the people we're working with do the same thing. If it were to change and things were to pass and work can come home, we would just become, again, another expert, a SME for other clients to want to work with us. Nobody's thinking about the broker-dealer license because the Clarity Act is not passed. Some people aren't thinking about being a TA or on-chain DTCC, but I think all of that stuff would change for a platform like us, and we'd consider like new product verticals, because we are the single best platform for anybody to think about issuing a token on-chain. And then to Alan's point about transfer agents or ATSs and so forth, settlement, this becomes a little bit more clear once the bill passes about how do these issuance platforms evolve, and you'll see some of the incumbents in this space either have an answer and a roadmap for that. Ours is we will just get bigger, we will verticalize, we will help people bring assets home and get them on chain.
Yeah, so I agree with you. You know, on Tuesday, we had our regular pilgrimage to Washington, and I spent a day with the offices of 6 to 8 senators and the Senate Banking Committee staff as well. And those meetings are really important just from kind of connectivity and discussion perspectives. I'll tell you, I think 50-50 is probably as good as it gets at this point. Just logistically, when you think about the calendar through the end of the year, and considering that it's an election year, and what that means when in October everyone disappears effectively, and the number of days that are left between now and the end of September, and that if you push things into the lame duck session between election day and the time when the new Congress is seated in January, you know, that's kind of where legislation goes to die, basically. So you probably have about 40 legislative days left if you kind of do the math, considering August recess, and then people disappearing at the end of September for elections. So for a meaningful piece of legislation that, and I know we all find it wild because we all care about it, but from a retail perspective, isn't something that senators and congressmen or women are getting inundated with questions from their constituents, please pass Clarity Act. It's not a retail issue. It's an institutional issue. It's an important one, but you know, it suffers from that perspective as well. But I'll tell you, as as regulated infrastructure provider in the tokenized security space, we're not sitting around and waiting for clarity. It doesn't really impact my business that much. It might make things a little bit easier for my broker-dealer to be able to tap different types of assets in a more holistic way, although I can custody crypto, including stable coins already. And we're one of the first 2 broker-dealers who were permitted to custody things on-chain and custody private keys, et cetera. But that piece of it doesn't get impacted. I think it's more in spot crypto space, and then of course new DeFi projects. And when you think about native digital tokens and what does it mean to raise seed capital for these projects versus kind of more seasoned secondary liquidity for these types of tokens. And that predictability is really important. There's been a lot of good vibes and psychology in the US behind the political change and headwinds turning into tailwinds, and that's been psychologically transformational. But politics are fleeting, and unless you put stuff into legislation, SEC can change, CFTC can change, Congress can change, and depending on your perspective, at least one chamber probably will change come the new year. So the importance of it is just that is future-proofing the industry. And again, politically, psychologically, it's been a lot of good things. The Genius Act passed, some other smaller pieces of legislation, but you need more to future-proof and protect the industry, and you can only do that through legislation.
Yeah, and I see 3 impacts of Clarity Act. So one, it's costs, obviously. So the costs will go down, which is very good. Yeah. So this means the market will benefit from getting better liquidity instruments, new one for lower costs. Right now, like before, let's example of the real estate market. So if you invest in a private deal, you roughly can get 12%. If you invest in the private deal that is packaged in real estate investment trust, private REIT, you roughly get 9%, so it goes to 3%. If this private REIT become public REIT and listed on NASDAQ or stock exchange, so you get 6%. So each step to liquidity, it's 3% cost. So from private deal to public, 6% cost. This is what liquidity costs, and token liquidity costs as well. And inside of that, there is all these fees charged by brokers, ATS, banks, insurance providers, and all of them is the function of Clarity Act. So the Clarity Act means the cost from private deal to liquidity shrinks, and everybody will win. So, and second piece, we'll get also a new type of assets in the US. So DAO, which is Wyoming right now, it's the #1 states for anybody who want to do LLC, which is DAO. But it's still difficult to trade them and make it tradable in the US because there is no agreement and standard whether it is security and non-security. So after Clarity Act, DAO tokens and governance tokens will become probably gold standard to raise money for DeFi protocols.
So there's all these different RWAs. There's tokenized stocks, tokenized private credit funds. In the next 5 years, which area do you guys see the most growth in? What will be the catalyst in that growth? And what could be things that could be detrimental and warnings to that growth? Igor, I'll throw this one to you.
I'm a big believer in so the new assets coming to on-chain. So those that is traditionally were not already tradable, but the assets that will become first time tradable because of the on-chain tokenization. So digital token first tokenizations. So such as real estate, IP rights, etc. And I'm also a big believer there will be new type of stable coin. So right now it's a stable coin is a main driver for the industry backed by US treasuries. So we are going to watch new coins, which is going to be index coins. So index coin, which is organically already used in the industry, what we are working on, the square foot, which is everybody in the US using this as a measure for price, for real estate, and in residentials, and Redfin, Roofstock, CoStar, everybody measure that, but it's not tradable and it's not popular. And it's just one step. This is exactly where a digital asset can step in and make the huge market out of that. And this is potentially the liquidity instrument that is needed in order to unlock liquidity on all those real estate liquid situations.
Maybe I'm a little bit conservative. I think we still have a lot of work to do with treasuries. There's some fun things we can do with high yield bond products. We have these out. I think we're going to see a lot of people. We have a partnership with Athena recently. We can do this with other stablecoin providers, but when people do want to take their balance sheet or some treasury of a stablecoin product and back whatever asset they're distributing on chain with a treasury, we have the JTRSY, JAAA, CLO, the high yield bond product that's coming out with a little bit more of an attractive yield. And then in the future, we'll have something that's a little bit more appealing than some private credit options. But I still think, yeah, treasuries and private credit have a long way to go. Private credit a little bit too volatile for the folks that want to loop things on chain. And so for those who are unfamiliar, like you can do a lot about the incentive games, about liquidity and leveraging. And with a JTRSY, like a treasury product or the high yield bond product, you can take the APY that's 4 or 6.5%, upwards of 9 to 11, using looping strategies on chain. And so I think there's a lot more precedent we have to set with, I don't want to say unrisky options, but a lot more proliferation of the, I guess, straightforward products like treasuries, treasury-backed things, and then leaning a little bit more into like constructive private credit options.
Yeah. So cash products, as you were saying, have seen a lot of airtime nowadays, and there's a lot of conversation now about public equities. Cash products, because of collateral management features that on-chain are a lot more efficient than traditionally. It's not like you can't borrow against a money market fund in a traditional ecosystem. Of course you can. It's just that it's a lot faster and cheaper to do that in a DeFi environment and to measure and to manage your treasury function. And so a lot of it is going to be use case driven, but a lot of it is going to be first principles driven. When you think about why tokenize, right? We talked about cross-border convergence and what stable coins are doing. And what happened to stablecoins will happen to securities with the addressable market for fundraising becoming more global. It still isn't. It still is highly fragmented, but becoming more global because tokenized securities can move faster and farther. Now, you still need regulated middlemen to talk to each other because laws matter, and each country is regulated differently. But what the technology did for stablecoins and remittances, you're going to see that for securities. Interoperability among asset types and unlocking liquidity because silos fall down, and public equities and private equities and derivatives and traditional crypto. Shocking that now there's such a thing as traditional crypto, and real world assets and predictive markets being more interoperable, and right, that's an objective, and you're going to see those silos coming down, and that's going to drive liquidity because money can move, can hop across far more easily. AI interoperability is a thing now. Agentic AI requires integration with whatever AI agents touch. A wallet with tokenized financial assets in it is a lot easier than a traditional bank account and a traditional brokerage account, et cetera. So if you don't believe in any other reasons for why tokenize, I think the top-down force function for being interoperable with a machine-to-machine economy is going to be a tailwind for tokenization of all sorts of records, including financial assets. I think generationally, you are going to see my asset, my wallet, my control, right? That psychology, that's not a blockchain maximalist psychology. They kind of anticipated a generational shift. That's going to continue to drive. So there are going to be a lot of forces that'll drive this, but it's going to be product-based and feature-based. And why is this better than traditional? And if you can't answer that question, if your answer to this is because it's tokenized, then you haven't done enough.
Now for my final question. If an institution could only ask one question before holding anything labeled RWA, what should it be? Anthony?
What are my legal rights? I think knowing the relationship between like what you're interfacing with off-chain should be the number one thing you care about. A lot of people in the space have synthetic exposure. It's not real. A lot of people aren't mirroring the underlying. A lot of people are probably could be leveraging something in real time when it has a 30-day NAV. Like you should be knowing what rights you have. Also, if that underlying goes bankrupt, some government seizes control of that underlying, what exposure do you have to these entities off-chain? What are your legal rights?
Igor?
Yeah, I completely agree with Anthony. I would add that when can I sell it? When and how? And if I need to get permission, from issuer or for somebody else to do that. So what exactly I own, and what I own on the digital token layer, and what I own on the underlying collateral on the real asset, and what's happened when. If something is going wrong and the protocol will disappear, so there should be like backfall mechanism how we're gonna still sell or transfer ownership of the asset.
Yeah, look, I think we're all touching the same point. It's if it's an on-chain SPV, you know what, do a lot of homework because there's fundamental lack of transparency and understanding around what you own and at what level. And to some extent, you get seduced by the tokenized piece of it because you think it's like Bitcoin, and a lot of these assets are not.
All right. Thank you so much, guys.
Thank you, Dave.
Thank you, Dave.